Sup guys, welcome back. Alright, so we gotta talk about these Trump tariffs because every time this stuff pops up, the market starts acting weird and people start panicking. You see headlines like new tariffs, trade war, import taxes, and suddenly everyone thinks the stock market is about to collapse. But here's the thing. Most people don't actually understand what tariffs do or how they affect their money. They just react emotionally. So in this video, I just want to break it down super simply. What's happening, how this could affect stocks, and what I'd personally be thinking about if I'm investing right now. And no, this is not political. I don't care what side you're on. This is strictly money. So first, what is a tariff? It's basically a tax on imported goods. So if the US puts a 10 or 15% tariff on goods coming in from other countries, that means companies importing those goods have to pay more. Now, companies have two options. Either they absorb that cost, which hurts their profits, or they pass the cost on to you, which means prices go up. And that's where inflation concerns come in. Higher costs can mean higher prices, and markets don't love that. Now recently, after the Supreme Court limited some of Trump's earlier tariff authority, the administration pivoted and rolled out new tariffs under a different law. So we're looking at roughly 10% right now, possibly moving higher. And every time this kind of policy uncertainty shows up, the market gets jumpy. Because markets hate uncertainty more than almost anything else. It's not even always about the tariff itself. It's about not knowing what's next. Will it increase? Will other countries retaliate? Will companies' earnings drop? That unknown is what causes volatility. So what actually happens in the stock market during tariff situations? Number one, you usually see short-term volatility. The S&P 500 can swing hard on headlines. One announcement and boom, red day. Number two, you see sector rotation. Money doesn't just disappear. It moves. Companies that rely heavily on global supply chains like automakers or big retailers importing tons of goods, they can feel pressure. Meanwhile, companies that are more domestic focused or more digital like software, cloud, certain tech companies, they're usually less directly impacted. That's why sometimes you'll see industrials red and tech holding up better. It's not random. It's money repositioning. Now here's where most people mess up. They see the market drop for a week or two and they assume this is the beginning of the end. But historically, tariffs alone rarely destroy markets long term. They can slow growth. They can create noise. But markets care more about earnings, interest rates, and overall economic strength. If earnings stay solid and the economy doesn't fall off a cliff, markets usually digest this stuff and move on. Now, could tariffs contribute to a slowdown? Sure, especially if they escalate. If other countries respond with their own tariffs, that can create more friction globally. That's when things get more serious. But right now, this feels more like a volatility event than a financial apocalypse. So the real question is, what should you actually do? First thing, I would not be panic selling solid long-term investments because of headlines. If you're invested in broad market ETFs like VTI or the S&P 500, you're invested in hundreds of companies. Some will struggle, some will benefit. That's the whole point of diversification. Second, I'd be thinking about balance. If your entire portfolio is super concentrated in one highly global import-heavy industry, yeah, maybe you're going to feel more swings. But if you have a mix of growth, some defensive stocks like healthcare or utilities, maybe some international exposure, you're probably fine writing this out. Third, and this is big, keep some cash. Not because you're trying to time the market perfectly, but because volatility creates opportunity. When fear spikes, good companies can get dragged down with the bad ones. And that's when long-term investors get rewarded. Now let's talk psychology for a second. Tariff headlines are scary because they feel dramatic. Trade wars, global tension, economic impact. But your portfolio doesn't care about drama. It cares about earnings over time. If you zoom out 5, 10, 20 years, most of these political cycles blur together. There's always something. It used to be trade wars, then it was pandemics, then inflation, then rate hikes, now tariffs again. There is always a reason not to invest. And people who sit in cash waiting for perfect clarity usually miss years of growth. Now, I'm not saying ignore risk. That's dumb. If tariffs push inflation up again, the Federal Reserve could delay rate cuts. Higher rates can pressure stocks. That's real. So this is why you don't go all in on hype. You build a framework. For me personally, my mindset is simple. If the market drops because of tariffs, but the companies I own are still strong, long term, I'm not stressed. I'm probably buying more. If the market goes up, great. I keep investing anyway. I don't base my strategy on one policy announcement. Because if you constantly adjust your portfolio based on political headlines, you're going to exhaust yourself and probably underperform. And let's be honest, most people don't even know their own risk tolerance until the market drops. It's easy to say you're long-term when everything is green. It's a lot harder when your account is down 10 or 15%. The news is screaming about trade wars. That's when you find out who you really are as an investor. So if you're newer to investing, this is actually good experience. You get to see how you react. Do you panic? Do you double down? Do you freeze? Learning that with smaller amounts of money is way better than learning it when you have 6 figures invested. Now let's talk about specific opportunities. Tariffs can sometimes benefit more domestic-focused manufacturing companies. They can benefit certain sectors that compete with imports. At the same time, multinational companies with complex supply chains might see short-term margin pressure. So instead of asking, what stock should I buy because of tariffs? I think the better question is my portfolio built to handle volatility? Because this won't be the last macro scare. Not even close. And if your strategy only works when everything is calm, it's not really a strategy, it's just optimism. So if I had to sum this up super simply, tariffs increase uncertainty, uncertainty increases volatility, volatility creates opportunity for disciplined investors. That's it. Don't overcomplicate it. You don't need to day trade the news. You don't need to jump into risky options trying to capitalize on short-term swings. Most people who try to outsmart headlines end up just creating more stress and worse returns. Stay diversified. Keep investing consistently. Keep some dry powder if you can. And most importantly, zoom out. If you're investing for the next 10 or 20 years, one tariff cycle is a chapter, not the whole book. And if markets overreact in the short term, that's not necessarily a threat. That can be a gift. So yeah, tariffs are back in the headlines. The market might get shaky, but shaky doesn't mean broken. Just make sure you're positioned in a way where you can sleep at night and not feel like you have to check your brokerage app every 10 minutes. That's really the goal. Alright, if this helped you think through it more calmly, drop a comment and let me know how you're positioning right now. Ignore the noise, stay disciplined, and I'll catch you in a bit.